Welcome to Something Personal, the show where we can't tell you where to live, but we may suggest some ways to get into a place you'll love. I'm Amy Laburda, the editorial manager at Palisades Hudson Financial Group. Joining me today is Vice President Eric Meermann. Welcome back to the show, Eric.
Hi, Amy. Glad to be back.
So, Eric, my gut sense is that owning a home is one of the more common sort of big financial goals. In your experience as a financial planner, does that hold up?
Absolutely. Home ownership is a way that people define their success, referring to a podcast from earlier this season. How do you define wealth? A lot of people will look at home ownership, starting a family, as one of the major life goals. So it's something we often talk about with our clients. A lot of our clients that are older or more successful already own homes, but certainly on the younger end of the spectrum, that's one of the conversations we have most often with people that are in their 20s and 30s, along with education financing for kids or having kids. Buying a home is right up there with the top topics that affect people's financial life.
I think it makes sense. There's an emotional component of having your own space, having independence. I think for some people, there's a sense of, oh, I'm really an adult now if I've bought a home. There's a lot of baggage that might come with it, but, for good and ill. But on a sort of more practical level, just like stepping back, looking at numbers, if you're in a position where you could afford to buy a home, is that always the smarter choice than renting?
No, it's not. It's not a requirement. You don't have to buy a home. There's a lot of factors that go into home ownership. One of them is financial considerations, but also lifestyle considerations. If you're planning to set down roots in a community, you have children or maybe not, but you plan to stay there for a long period of time, then a house could make sense. But if your life is still in flux, maybe you're going to go back to school, maybe grad school, maybe you're thinking of moving to a different part of the country. There's a lot of different life events that can happen that would cause you to have to up and move. And when life isn't totally settled, I don't think a long-term investment in a home is necessarily something you want to do. You can, and then you're subject to the risks of the housing market in which you purchased your home. If the market goes down, you could get stuck there for a while. If the market goes up, well, you can sell it and flip it. And if you don't mind doing a lot of paperwork and working with a lot of lawyers and mortgage brokers, it's not that big a deal. But most people don't enjoy the mortgage process and the closing process. So I would say, it's a big undertaking. So you want to be sure that you're ready to spend a significant amount of energy in the home buying process.
And speaking of being ready, we've talked again on earlier episodes of the show about the importance of setting a savings goal for a big project like a down payment for a home. How do you know what the number is? Like, when have you saved enough that you're ready? Obviously, it'll depend somewhat, but are there any things to look for?
Well, I think looking at budgeting for what you can afford on a monthly basis is part of the equation. The other main part that you often hear, especially from a young first-time buyers, is I can afford the monthly mortgage. I just don't have the down payment. Mm-hmm. So saving up that 20% of the fair market value, or, the value of the house. I use that. It's sort of a rule of thumb, but it also has financial implications, which we'll talk about later as far as the getting a mortgage for your home. But until you get to a place where you can put down 20%, for most people, I would say, that's a good goal to feel like you're ready. I would also say you want to have a little money left over for things like maintenance, buying your furniture. Obviously, closing costs are part of the initial purchase. So, if you had $100,000 and you were buying a $500,000 house, you're not going to have enough to buy a couch or even close on the property. You probably want to have a little bit more saved up than just the 20%.
Right. So it's not even just the 20% and the monthly mortgage, but you'll need a bigger cushion than that, sounds like.
Yeah, absolutely. Because once you own the home, as most people end up using a mortgage to purchase their home. If you don't pay your mortgage, eventually the bank will foreclose on you and take your home back. So if you have no cushion, if you bought a home and you're living check to check after you buy the home and then you lose your job for 8 months, you will also potentially lose your home. So you want to have more cushion than just the 20% equity in your home.
So on the subject of mortgages, I'm someone who has not gone through the home buying process myself. So I know it sort of took me a while to internalize the difference between pre-qualification and pre-approval when you're talking about a mortgage. If we have listeners in the same boat, can you clarify a little bit for them what the difference between those two things is?
Yeah, so I'll just back up a minute to talk a little bit more about the budgeting, where you're looking at your savings to say, okay, do I have enough for a down payment? And then you're looking at your monthly expenses and you're trying to figure out, okay, after I put down 20%, so in this $500,000 example, your mortgage would be $400,000 at a rate of, the prevailing rates have been a lot higher, but are expected to come down. We had our recent first cut. So you would take that interest rate and term and expected mortgage and come up with a monthly payment for that $400,000 of mortgage. And you would look at your budget and say, you know what, we can go bigger than this. We can go $650. We can put $130,000 down and then the rest on a mortgage. So you kind of want to go through that yourself. You don't want to rely on the mortgage company, which is to your question about pre-qualification and pre-approval. Mm-hmm. Don't let them do the calculations for you. Either do them yourself or use online calculators. There's a lot of stuff out there that can help with this, or preferably, talk to a financial advisor like Palisades Hudson. With that said, to answer your question, the pre-qualification is just getting an idea from the lender that you're going to borrow from, how much they're willing to give you. You give them a minimal amount of data, income, assets, but you're not doing the full, uploading many years of tax returns and W-2s and pay stubs. You're not at that part yet. That's where the pre-approval and application process starts. So pre-qualification is like, just give me a ballpark idea, Mr. Lender,
right,
about how much I can get from you so that I can buy a house. Pre-approval is a much more formal process where you're having a offer to lend for a certain period of time, something like 90 days that says, we have approved this. We've done all that due diligence on your income, your expenses. We've looked through your tax returns, and we're willing to give you this amount of money, but it doesn't have, an infinite life. They put a time limit on it because your circumstances could change.
So it sounds like it's important to sort of separate the budgeting exercise you were talking about, thinking about what you can actually afford, what you can maintain, from the exercise of what a lender is willing to give to you, because those two numbers may not, in fact, be connected.
Yeah, absolutely. Like if you have really good credit, they might be willing to give you much more than you actually would want to borrow or can actually afford. When I bought a condo in 2015. And at the time I was unsure exactly what type of property I wanted, whether I wanted a single family home or maybe a multi-level townhouse or an apartment style condo. I was sort of very flexible. So when I went through the pre-qualification process, the number that they gave me, because I had really good credit, was way more than I would have wanted to spend on a house, looking at my monthly budget. And so I would caution people that pre-qualification or pre-approval number is not the amount that you have to spend or that you even should spend.
Right.
It's just what they're willing to give you. So I would go back and look at your budget and say, do I really want to live like that? Do I want to, have every dime going to my house and not have a lot of free cash flow to go on vacation or buy cars or clothes or dinners or whatever?
Before we get too knee deep in the mortgage process, we'll come back. But I wanted to talk a little bit about home equity, since as a renter, that's one of the things that's sort of on my mind as renting versus home buying. I assume most listeners have heard the term home equity, and some of them might have a good idea what it means. But just as a baseline, can you give us a definition of what we're talking about here?
Sure. The simple answer is it's the difference between the value of your home, what we call fair market value. That's what someone would buy it from you for, and the mortgage balance. So in that example before, let's say our homeowner had lived there for a number of years. They bought it for $500,000. They had $100,000 down, and they had a $400,000 mortgage. So their home equity at the start is the $100,000. But let's say, a number of years have gone by and they've paid down the mortgage, and it's now the mortgage balance is $350,000. So now their equity is $150,000. And then you could say, well, the property has appreciated 10% over those number of years. So now it's $550,000. So in that example, now you have 200,000. So you've basically doubled your home equity over that example from 100 to 200. And that's the effect of leverage, because with only putting 20% down, you're leveraging your equity by using debt, which sort of amplifies the returns potential.
When you hear people talk about home ownership as a sort of form of forced savings, is home equity usually what people are talking about there?
Yeah, absolutely. And they're talking about it through the monthly mortgage payment. So when you pay rent every month, the rent is just gone. You know, it's you're paying for the usage of your apartment for that 1 month. You know, assuming you have a year lease, you have a commitment to do that every month for a year. But then at the end of the term of the lease, at the end of the year, you own nothing, you have nothing, and you know, it's just zero. Whereas a similar mortgage payment, in the example before, a big piece of that is going to principal pay down. A mortgage is composed of generally two components, the principal and the interest. The principal is like paying yourself back. The interest is obviously interest.
Sure. So if people are talking about home equity loans or line of credit, that means that they're then using that equity as collateral for an additional loan or drawing additional money basically against the equity they have in their property. Is that right?
Yeah, that's right. So, you know, in our example where you've lived in the house for a while, you've built up equity, and you've paid down some of your mortgage. Sometimes life events will happen, or you want to do something, you know, different with your life, buy a second home, you know, vacation home or something, or you face financial hardship and you need to access your home equity. You know, there's a number of ways to do it. You know, the first being just sell your house, go back to renting, or buy a smaller house. Then you also have other debt options besides the mortgage to take some of that home equity and be able to use it. And so that would be the home equity line of credit and a home equity loan that you mentioned.
Backing up a little bit, you mentioned earlier, most people who are buying a home will have a mortgage. I think that's feels true on a gut level, but also in your chapter in the High Achievers Guide to Wealth, our book, you cited the National Association of Realtors in observing that about 78% of American home buyers finance their purchase. So that is a hefty chunk of people buying homes. Obviously, if you're in a position to buy a home outright with cash, there are advantages to that, but that's just not realistic for most people. So let's go back to mortgages and sort of the nitty gritty a little bit. What are the main types of mortgages that home buyers might see if they're on the market?
To keep it simple, the first one is fixed rate. And the second one is variable rate. So a fixed rate mortgage is exactly what it sounds like. The interest rate that you lock in is fixed for the entire term of the mortgage. Typically, you know, your 30-year fixed rate or 15-year fixed rate are the typicals. Although if you're, say, you're already a homeowner and you're refinancing because rates have gone down, a lot of times you can pick whatever number between 1 and 30 that you want. When I refinanced in 2020 during the whole COVID thing, the interest rates went way, way down. So a lot of people refinanced, and I chose a 20-year term because at that point I had paid down a little bit of my home equity, and I was able to keep my mortgage payment exactly the same. And I calculated, you know, the term that would have my mortgage payment be the same, but basically took like 5 years off the term so it would be paid off sooner. The other type is variable rate or adjustable rate mortgages. These can be quite complicated and structured in many different ways. There'll be a period in which the mortgage is at a fixed rate, and then there'll be a period where the rate resets, is variable. So as rates go up, your mortgage payment will go up. As rates go down, your mortgage payment will go down. A very typical one is what's called a 10-1 ARM. So that's 10 years, 1 year adjustable rate mortgage. And what that means is the 10, the first number, is the fixed period. So, you know, if rates are really low, you might lock in a 10-year really low rate. But then during that 10-year period after that, the 1 in the 10-1 is that every year after that, it adjusts annually. So we saw this a lot in 2000 and 2001 after the dot-com bubble burst. A lot of people did 10-1 ARMs with extremely low 10-year fixed rates, or maybe 5 years. And then that contributed in part with a myriad other factors to the Great Recession, in that people then had their mortgages adjusted upwards in the adjustment period after the fixed term was over. And that ended up causing a lot of people that couldn't afford their mortgages anymore because rates were so much higher in 2006, 2007, 2008, leading up to the Great Recession.
Makes sense. And not to get too deep in the weeds, but it's just a thing that I always remind myself. With adjustable rate mortgages, you'll often see two numbers, but those two numbers don't always necessarily refer to the same things in different arms. Is that right?
Yeah, that's right. So a 327 arm is a 3-year fixed. It's a 30-year loan. 27 of it would be floating. So yeah, there's lots of different ways, and you should talk to a financial professional to help you understand it or do your own research.
Makes sense. So we've talked a little bit about the importance of budgeting and understanding what you can afford. And now we sort of talked about the types of mortgages. Say you're a prospective home buyer and you're like, okay, I have a budget and I know which kind of loan I want. We talked a little bit about pre-approval and pre-qualification. If you're starting to shop for a mortgage, do you just go straight to your local bank, or should you take a little bit of a wider view?
Yeah, there's a lot of options for lending these days. There's online only banks that are willing to lend. You have local banks, credit unions. You have major national lenders like the big banks. In this situation, you really want to look at not only the interest rate, but also the other costs associated with setting up the mortgage, including fees or closing costs and things like that. And that's where you would look at the APR, which is the annual percentage rate. That number helps you judge between different lenders what the total cost on an annual basis is. It looks sort of like an interest rate. And I would say you consider both, because you want to lock in a good interest rate, but the APR helps you figure out how much of the costs look like an interest rate, because someone might be lowballing you with a low interest rate, but then there's a ton of fees.
Sure. So it sort of helps you compare apples to apples between different lenders.
Yeah, that's right.
Makes sense. So I think when you're shopping for a mortgage, people who have owned a home before are aware that property taxes are bundled in to the mortgage. If you're coming from renting, you're buying your first home, what do you need to know about property taxes? Is that a thing that just the lender will take care of, or do you need to have more of an awareness of what's going on there?
You definitely need an awareness of it, because property taxes across even cities within the same county can vary very dramatically. So, for example, here in the Northeast, I live in Westchester County, some of the river towns, which are on the west side on the Hudson River, their property taxes are known to be extremely expensive compared to other towns that might have more revenue from, say, businesses that or sales tax that helps them offset their budget. Other towns might not have that, or for one reason or another, or they have excellent schools or amazing roads. So when you're looking at a $500 or $1 million house in one neighborhood, and then you look in another neighborhood, you think you have the same budget, but property taxes are $24,000 a year in this town, and they're $12,000 a year 3 towns over. So you need to account for that in the budgeting process, and also know what you're getting, obviously, because obviously a lot of people that are looking at homes, especially younger folks, are very concerned about the school district and want to, maybe willing to pay for their children to have access to, the best schools compared to, that town over with half the property tax might have terrible schools. And so you might be willing to pay that.
You can sort of decide in your budget how much you want to be paying for the location, essentially, with property taxes. Yeah,
you got to look at the whole overall picture. And so to answer your question about the lender, they're going to require escrow. And what escrow is where a third party, in this case, a mortgage lender, they receive the money from you with your mortgage payment, and then they disperse it to the township or the county or the city on your behalf. The reason they do this is because until you pay off your mortgage, the bank has an interest in your home, and they want to make sure that you are funding all of your liabilities around that home, so that if they end up taking it from you, that they don't get stuck with it. So that escrow payment is part of your mortgage payment. You'll typically, which we'll also talk about later, include insurance. So when you go through the budgeting process, you're going to add all those things together. The mortgage, which includes the principal and interest, plus the homeowner's insurance, plus the property tax component, and that'll be what you pay to the bank. And then in addition to that, there's other things that can come up, like HOA fees or maintenance or repairs and things like that.
Okay. So I know at Palisades Hudson, one of the things that you and our colleagues do is to help our clients sort of keep an eye on the big picture, financially speaking overall, and for tax specifically. So briefly before we move on, besides the property tax, can first-time homeowners expect other effects on their tax planning from owning a home?
Yes, the big one would be the mortgage interest deduction. So as we were talking before about the components of a mortgage payment, principal and interest, the interest part is deductible as an itemized deduction on your tax return. Mm-hmm. I found it very interesting when I was going through the home buying purchase that the bigger house you bought, the bigger mortgage you would apply for, the more interest you would pay, which would then, if you did a tax projection as a deduction, you could then get a much bigger amount of that interest back as a refund. And then what I recommend as a financial advisor is not to then just have this huge, almost like bonus-like refund come in April. What I did is then adjust my withholdings so that my biweekly paycheck would end up with me being basically, even or a little bit of a refund at the end of the year. So weirdly, by buying a house and having the mortgage interest deduction, you're almost giving yourself a cash flow raise on a month-to-month basis, which can then allow you to buy a bigger home. Now, you got to be careful with that as a financial advisor, because you say, well, the bigger the home, the bigger the mortgage interest deduction, the more take-home pay I get. So I'll just go bigger and bigger and bigger. And then you get yourself into a situation where you bought way too big of a house and you can't afford it. Right. So I would be careful about that, but adjusting your withholding on your pay to account for the fact that you have a mortgage interest deduction now, it definitely is something that you should discuss with your tax preparer when you're doing the budgeting process. Or you could just keep it as cushion and not think about it, and then have that available for all the unexpected unknowns that pop up in home ownership.
Sure. I imagine having that extra in your pocket for maintenance or unexpected problems that occur in your home is never really a bad thing. So I want to circle back briefly. You mentioned HOA fees earlier and things that you might have to expect to build into your monthly payment. What should first-time homeowners know about HOAs or potentially condo associations if they're going for a condo?
Yeah. So in addition to all the types of payments we were talking about before, mortgage, insurance, if you live in a place that has an HOA, which could be a single family home in a developed community, it could be a co-op in New York City, it could be a condo like where I live in White Plains, you might be subject to an HOA, which is a homeowners association. They will charge dues every month, typically not deductible for tax purposes. And that covers upkeep of the common areas. So in a development, that would include, like the roads and stuff like that, sidewalks. I have more experience in the condo world where it would include a whole host of things. So just to use my personal life as an example, my HOA fees are very high, about $1,000 a month. But when I think about it financially, I say, well, I don't have to pay the gardener. I don't have to pay the pool guy. We have a pool. I don't have to do any of that myself. I don't have to shovel the snow. I don't have to shovel the sidewalk. I don't have to hire a security guard because we have a 24-hour security guard. All these things that you get a benefit for, that if I lived in a single family home, I'd have to have someone to rake the leaves in the fall, shovel the snow in the winter, cut my grass in the summer. And that would, if I had a pool, I'd have a pool person. That can all get really, really expensive. And it also includes things, maintenance wise, and not just services, but, if the roof needs repair, the boiler blows up, major leak in the pipes, all of that is included in the HOA fee that I pay. So it ends up being, from a budget standpoint, not all that much different, even though it sounds on its face, wait, you're paying this mortgage, interest, principal, all this, and you're paying $1,000 on top of that and the property tax. But then when you think about all the stuff that you don't have to pay, it ends up, for some people, working out pretty well. The downside of living in an HOA is that you're part of a community that then can sometimes get restrictive as to your behavior or decorations or when you have to bring the garbage cans in and stuff like that. And people that prioritize more personal freedom in their lives may be constricted. If I want to put up multicolor Christmas lights. Oh, no, you can't do that. We only allow white lights.
Yeah, I have a friend who got into a bit of a fight with an HOA about a fence and the type of fence and how tall it was. So I think those kind of things
fences are a big deal.
Yeah, a thing that HOAs sometimes have a reputation for. But as you say, it depends where you're living, the trade-offs of the services and the benefits and the drawbacks. Although it does seem like a lot of times when you buy a house, it's a take it or leave it. If they're in an area governed by an HOA, that's sort of it. It's not always an opt-in thing.
Yeah, that's right. Like if you want to live in that neighborhood, it has beautiful homes, great schools, and it has an HOA, then it can be a great thing. And like I said, it does provide a lot of services, and it's just a sort of a personal perspective. So from a personal standpoint, you have to think about it, and then from a financial standpoint, you have to build that into the housing budget.
Sure. So speaking of budget line items, let's circle back to insurance a little bit. I spoke in an earlier episode this season with our colleagues, Brianna Aviles and Mamie Odom, about renters insurance. I think usually there, more often you see a problem of awareness. People either don't know that they need it or think that it's way more expensive than it is, but it's usually a pretty good deal for most renters. On the flip side, homeownership in general, it's understood that you have to have insurance, not least because most mortgage lenders require that you have it. But if you're a first-time homeowner, you may not actually know beyond, I have to have it, what the types are, what your options are. What are things about homeowners insurance? What are your options that you should know?
Yeah, so there's generally 8 different homeowners insurance policies. I don't think we need to go through all of them, but I'll describe the main ones that you'll encounter. So there's sort of a basic, which is named peril, where it specifically says these are the causes that we'll pay for. And if something else happens outside of those named things, you get nothing. That's not good for most people because you never know what could happen. HO3, so there's numbers HO1, 2, 3, and so on. HO3 is the most common homeowners for insurance for single family homes. This covers everything that could happen except those things which are specifically excluded. Typically, one of the things that would be excluded would be flood damage. And with the major hurricanes now in Florida, we know that is run through the National Flood Insurance Program. And so there's set rates for that for flood, but the HO3, that's going to cover pretty much everything else that could happen except the named exclusions. HO4 is renters. HO5 is a more souped up version of HO3 where it names even more perils and has broader liability coverage. But of course, for that extra coverage, it would be more expensive. HO6 is basically HO3 for condo owners. So that's your condo. 7 is for mobile homes. And 8 is for old homes, like historic or registered landmark type homes. So those are the basic types. So if you own a mobile home or you own a condo, which one you have to get is obvious because that's the type that you need. But generally, comprehensive plan that doesn't have named perils, but rather the named exclusions is the way you would want to go. And as far as the premiums, like I said earlier, those are typically, if you have a mortgage, going to be included in the escrow portion of your monthly mortgage payment. If you own your home outright, either you bought it all cash or you've since paid your mortgage off, you will be responsible for paying that directly.
So I think we've talked about a lot of things you have to pay money for, which when you're buying a home is probably expected. But let's take a step to something a little cheerier than insurance. I think a lot of people, especially first-time homeowners who have previously rented, look forward to the ability to customize or upgrade their property now that they're owners. They're able to do things that wouldn't have been practical or possible as renters. As a financial advisor, do you have any tips for homeowners who are either first-time home buyers or about to own their first home and are excited to sort of dive into these home improvement or home expansion projects?
Yeah, sure. I actually listened to Brianna and Mamie's podcast, and they did a good job of capturing the essence of what it's like to be in your own place for the first time. And so as a homeowner, it's pretty cool because you can look at it and say, this is mine, this is my thing, and I can do what I want with it. And that's a really empowering feeling. And so as you do that, looking at it from a financial perspective, you can add to the value of your home, that home equity we talked about in the beginning, through capital improvements and properly maintaining and caring for your home. If you were to allow it to fall into disrepair, the potential buyers that would make up that fair market value, again, remembering that something is worth what someone else will pay for it. Even if you don't intend to sell it, your home is based on a hypothetical buyer, coming in and buying your property. So if it falls into disrepair, people would pay a lot less for that. I had a friend that bought a house that had it was a 2-level single family house, and the upstairs had a space for a bathroom, but no actual bathroom. It was just sort of like spaced out, but the old homeowner never put it in. And so, most buyers looking at, he paid a little less. Most buyers looking at that would say, no, I want the bathroom to be there. And smartly, he went through the process of getting the plumbing installed to the second floor, which I think was what stopped the original owner, and completed the bathroom. And so that would certainly increase the fair market value. And that would be a good example of a difference I want to highlight between capital improvements and maintenance. So in that example, you had a basically blank space room, with like empty walls and a hole in the ground. And so that was adapted to a new use, which is an IRS term, for determining a capital improvement. A capital improvement is good for tax purposes because it increases your basis in the home. So my friend installing the toilet and the tub and the tile, the cost of all that gets added to what his cost basis is, which at some point in this series, we'll be talking about capital gains, I would assume. When you go to sell your house, you're going to be subject to tax on the difference between your cost basis and what you sell it for, less some expenses. So the more cost basis you have in your house, the less tax gain you'll realize when you eventually sell it. I'd like to distinguish capital improvements from maintenance. So painting the bathroom, maybe it got, scuzzy or something and it needed a repaint job. That's not a capital improvement. Mowing your lawn, not a capital improvement. Capital improvements tend to be big things that are adapting the space to new uses or creating new space in the house. So, for example, putting on an addition, or if you had an uncovered garage area, if you were to install a covered garage connected to the house or something like that, those would be capital improvements.
All right, that all makes sense. So, as usual, I like to give the last word in an episode before we wrap up to my guest. So, is there anything else you'd like to say about homeownership or how to include your home in sort of your big financial picture before we wrap up here?
Sure. I think we've covered a lot of it, but, it's stepping back and looking at the overall picture. A home is an investment because it does have value and fair market value, but it's also where you live, right? And so a lot of people look at it and say, well, is it investment or is it personal use? Or how should I think about it? Is it part of my overall portfolio? Certainly it's part of your net worth, but everybody needs a place to live. So I wouldn't go out and buy a home just for the purpose of trying to create value from an investment standpoint if you don't actually want a home. If you want to continue to just rent and save your discretionary cash flow in a diversified portfolio over the long term, you might end up with more money than the leveraged future appreciation in a home. Because a home is a big commitment. It's got a lot of effort and expense that goes into initially purchasing it, as we've spent a lot of time on, but also maintaining it, cleaning it, repairing it. It's a big responsibility. So it's not something people should take lightly. And overall, though, it can be a very rewarding experience to own something yourself, have control over what you do with it. And certainly it is part of the overall portfolio of wealth as we define wealth as a broader than just the number on a net worth statement. So overall, we've talked a lot about the difficulty and energy required to purchase a home, to get a mortgage, to refinance that mortgage, maintain the home. But overall, home ownership can be a very rewarding experience for most people. The ability to control your own space, enjoy it the way you want, makes home ownership ultimately a really rewarding and satisfying thing.
I think that really explains, as we opened, why it's such a big goal for a lot of people. And I hope the episode today has helped some of our prospective buyers out there feel a little bit more prepared. Eric, thanks so much for joining me on the podcast today. It was great having you back.
Thanks, Amy. It's great to be here.
Something Personal is a production of Palisades Hudson Financial Group, a financial planning and investment firm headquartered in South Florida. Our other offices are in Atlanta, Austin, the Portland, Oregon metropolitan area, and the New York City metro area. Something Personal is hosted by me, Amy Laburda. Our producers are Ali Elkin and Joseph Rangeli. Joseph Rangeli is also our director, editor, and mixer. Our firm has written 2 books, Looking Ahead, Life, Family, Wealth, and Business After 55, and The High Achiever's Guide to Wealth, which offers advice for younger professionals, entrepreneurs, athletes, and performers. Both books are available on Amazon in paperback and as ebooks.